Hello and welcome to our latest episode of the Swing Traders Weekly Status Update. It's Justin Nielsen here, and Mike Webster is joining me again. He had some computer troubles last week. Man, it was rough, but he's back in business. And actually, he was shortly after we started our program. But man, Mike, what
happened
week.
while I was away?
Yeah, exactly.
Well, my internet
you
was
weren't
down.
really away, so
I know.
you've been busy,
Yeah.
as our Swing Trader subscribers can attest to. So a few of the things we'll talk about. We were using the term Ro-fake-tion because Lucy's been putting that football down, and Charlie Brown has been kicking, and she keeps on pulling it away. But this time, it seems like Lucy left the football there for us.
It feels like it. This feels like the first time that this rotation into small and mid caps and basically everything but Mag 7 is sticking. And we've been doing this head fake for about 3 years, maybe longer than 3 years, where it would look like it was going to rotate and it didn't. And this one feels real. The evidence that we have at this point is this rotation is for real. We always take it one day at a time. We don't predict. We just kind of move with what the market is doing. That's what Bill O'Neill, the founder of IBD, taught us, to do. But yeah, on the Russell, you can see, since really, I guess, yeah, the entire time you have Mark there, it kept on trying to break out. It would look on a daily, certainly would look like it was ready to go, and then it would just roll over. But you can tell even on this last week's bar and this week's bar so far, completely different character change. If you can go to like that December quarter of 2021 where it poked up at the 2458, and so you had 1 week there that looked really compelling, but then it was the following week stalled a little bit, which was fine, but it was then the next 2 weeks that just told you that rolling over wasn't normal for a breakout. So when things break out, they should have this thrust like what we've had so far. So by Friday, it doesn't need to be at higher than where we're at, but we just don't want to be closing in the lower part of the bar, or certainly in the the lower quartile. That would make it seem just like, okay, another rotation that failed. But so far, as we have it, there's no stopping these. We should have some natural pullbacks. That would be healthy, but so far, so good.
And I want to just real quickly address the relative strength line, because when we did have the November 1st follow-through day, 2023, it did seem like the Russell 2000 was right there. It seemed like, okay, this is moving. It's getting above that 2000 level right here. That was a sticky point for a long time, and then the relative strength got above its moving average lines, and then it just couldn't do anything afterwards.
Yeah, so I'm glad you pointed that out, and that's why we use the moving averages of the relative strength line to kind of keep us to have us a tool that's black and white that tells us, is this for real or not? And so as long as that RS line is, let's toggle over to the daily to see a little bit closer. As long as that RS line is above those moving averages, this move into the small cap space, and basically it's not really just small caps, it's everything but Mag 7 for the most part. It's very broad base. As long as on the MDY, the Russell, the VXF, all the non-SPY and non-Q ETFs and indexes, you want to see that RS line staying above those moving averages. Now, we always talk about a 50% retracement being normal. So that means that from our gap up that we had last week to our current highs, we could fall 50% and still be normal. So you can give back 50% of those gains and not know that.
So real quickly, would you take the 50% when you're taking this time frame? Are you taking the low as the low of that gap up day, or are you taking the close from the previous day?
Yeah, the close from the prior day
Right. Okay.
is
So
where I would do it. Now, it's an art. You could make an argument for the gap up, but I tend to use the day before the gap up because that's really where things are breaking out, and that's the new area. So keep in mind that's a long way down. Now, just because they can go down 50% does not mean that they all go down 50%. Some of them only retrace 25%, some about 33% ish. You know, that's healthier. But I always try to think of worst case scenario is half of that can retrace as just a natural reaction that's happened since the beginning of time and it always will happen. Because you have people up here who are saying it went too far too fast and they're going to short it, or people just taking profits. Nothing wrong with that. And then the buying pressure subsides, and then it pulls back in, and then that's where you really see, is this for real or not? So time will tell. Doesn't mean that we're going to have the 50% retracement. We could certainly go higher before that, but this is very powerful in a short period of time. So whenever that happens, I'm always just mentally preparing for a pullback. Doesn't mean that they always happen.
right now, on the flip side, we got to talk about the other index that
Mhm.
was getting all of our attention, the NASDAQ Composite, of course. This was what the Thursday looked like. And look, the NASDAQ isn't broken. I mean, it hasn't even
Oh,
broken below its 10-day moving average line. But there certainly has been a little bit of a change in character in terms of, the relative strength lagging a little bit recently. And if we look at SPY, which, we're not going to look at the relative strength there, but, this is not doing, too badly. And you mentioned the S&P 500. I mean, the RSP, which is the equal weighted. So again, it still has the Mag 7 in there. They just don't get the huge weight that they would in the SPY with the market cap weighting.
yeah. Well, your RSP is your fair index, right? Everything is created equal there, so all 500 have the same size versus the SPY or the Nasdaq or the Qs, which are market cap weighted, or even the IWM or MDY, which are market cap weighted. So, looking at RSP as well as if we can pull up the QQEW, which is the equal weight of the Qs, that's helpful. A helpful way to look at the breadth, meaning, is it just a few names participating the way we've had for quite some time, or are things broadening out? And you can tell, not so much with the QQEW, but let's toggle back to the RSP, that one is really broadening out. And really what's happening there is you're having a lot of different groups that are starting to participate. So the financials have come on, a lot of your industrial related stocks, basically everything but tech is starting to rip up. But the tech isn't falling apart. Let's pull up SMH, for example, which had been our leading sector, and that's just putting in its time. So it's
Mhm.
really kind of Goldilocks right now. It's always your famous last words before you know you run into trouble, but you can't predict. You just have to look at right now. Everything that we wanted the market to do, it's doing. It's broadening out. It's finally going in the small and in mid caps, and the large cap, mega caps. They're not falling apart. They're just putting in their time and base building for the most part.
Yeah. Let's go ahead and I'm going to ask our producer to go ahead and put this chart down, and I'm going to show kind of just a recap from last week, because I think it's worth kind of just reminding folks what we were saying last week, and what we were doing last week, because I think there's something to learn here. So last week, what we talked about, and even though Mike wasn't on the show, he was in the background. He wasn't just sitting on his hands doing nothing. But we talked about last week that on July 5th, so the day after the 4th of July, we had this very heavy weighting in software between IGV, Microsoft, CrowdStrike, very heavy weighting in software. And then, a week, or actually not even a week later, July 9th, when we had our last SwingTrader update just a week ago, we had really kind of shifted dramatically out of software. It had come up to its highs. It started seeming like it was stalling out a little bit. And we were spreading that out into other areas, including a cash position. So we had raised our cash weight to 20%. We've reduced our weight in software by 30, down 30%. And it was just kind of like, look, we're recognizing that the NASDAQ is extended, that we could be due for a rotation. And we, kind of were talking about the Ro-fake-tion. And even though we were saying, yes, maybe it's coming, we had to kind of play both sides. Like, maybe it happens. It looks like it's going to happen. And as many times as Lucy has pulled this football, you can't just say, okay, well, I'm not going to do it again, because that's always the time that it really works. So we we went forward.
Go ahead.
And here's where we're at now. So Mike, a lot more spread out in terms of our areas. And again, remember that basically after we had our SwingTrader update last week, we actually came down a lot more in internet and chips and these other areas. We dramatically reduced that. But now here we are. We're in finance, we're in retail, we're in building, telecom, transport, software, machine, leisure, medical. And then there's this big portion in ETFs. And if we kind of take a look at what ETFs we're in: small caps, home builders, innovation, RSP, financials, infrastructure, gold miners, and software. So what's your take on all this? Why, take us back to Thursday, I guess, because
Sure.
Thursday was really, the CPI report comes out. Things were looking strong at the beginning, 10-year treasury yield coming down, and that really just caught these on fire.
Yeah, so there's this major shift that happened on Thursday, and going into Thursday, and why we were doing what we were doing that you were just going over, is raising cash and everything, is because the Webby RSI, which we talk about every Friday when I do the show, the SMT with Ali, and we go over, that's the low versus the 21-day exponential, and because that had gotten to overheated territory, that it was natural and expected for it to pull back in. Doesn't mean that they have to, but that was normal. And so that's what we were preparing for. Because remember, this is not an orthodox product. This is a fast moving active product. We call it swing trader. I refer to it as active trading because it's not necessarily swing trading. It's active. It's, we would like to be less active, but that hasn't been the market that we've been given, and hopefully we're kind of shifting into that now where we can leave some things on for longer periods of time. That's what I would like. That's really where you make your money, is as things are working and you're kind of at least letting a part of that position kind of bake and run up, but we'll take off some profits and let a little bit of them go. That's the intent. But what was happening is we were extended on all of those on the mag 7 type names, and we were concentrated there, so we were having to reduce. And because we didn't want to go too quickly, what we did is we put the QID on, which is the inverse of the Qs, as a protective measure until we could reduce each position. So it was a hedge for those, and then we were switching over right away into the small caps via the IWM, and then we went with the RSP, which, because the market didn't look bad, it was just that the select few of the Qs, the largest cap ones, looked like they needed to come in. So that's why we went with the RSP. We went with kind of an oversized position there, which we've reduced down to a normal size. But we went with the IWM, and we've pushed that to the biggest position size that we've had since we've kind of changed strategies since I've come back. So we've got a big position there. That thing, like I said earlier, could come in, but the reason why we're spreading out is because we can. Bill O'Neill was always into concentrating and just getting as much money into the few stocks that he liked the best. And he would start off with 5 to 8 stocks and whittle it down to 1 or 2 stocks. But with that comes a lot of risk. And so the way I like to do it is to do kind of a shotgun approach and spread things out as things are working, adding to those, and then concentrating. And that's what we had done before. We'd kind of gotten concentrated into the big caps, and then it gone up too quickly. Then they needed to come back in. So I would expect more of this in the short term of us spreading out. We're not really on margin, we're just fully invested. And so that means we have some room, we're kind of comfortable going 10 or 15% out on margin because of the ETFs that we have, which bring us diversification as well as all these tiny positions that we have. Like you've got the chart up there, 2.5 in this and 2.5 in that, maybe 5% here or there. So we're spread out, so that protects us to a certain extent. Of course, if the market collapses, everything correlates to one and everything comes down. But assuming that we don't have that, because you can never predict what news would drive that spreading out right now makes sense. We'll see what sticks. Maybe software comes back. Maybe the Mag 7 come back. We're going to be open to that. We're agnostic. We just want to go where the relative strength is, as well as things that aren't extended. Right now, that's the problem. Things get super extended super quickly. So from a swing trading standpoint or an active trading standpoint, if you have relatively tight stops the way we do, that becomes problematic. So that's another reason why we're going with these ETFs, because we're less likely to get shaken out in there as we would in an individual stock, if we have a pullback or when we have a pullback.
Mhm. One other thing I just want to mention is you talked about how Bill was all about concentration and everything like that. Although I will say, after 2008, he kind of started approaching things with a lot more diversification himself. Wendy, a good friend of ours, was one of the portfolio managers, and she kind of did that shotgun approach and was having success with it. And I think, it's one of those things. As you get older, sometimes you don't want to be the cowboy that you were when you were younger and going all in on just a few names.
Yeah, and I studied what Bill did, and you saw it in real time, of what he was doing for, all the time that you were with him, until he retired, and that he traded differently over time, and he would change. And I ran a list with him, like you and I and Dominic and Chris, we run this. I ran with Bill the Nesme list, which was for institutions. It was more of an orthodox, think of a leaderboard type of strategy, and we would have 50 to 80 to 150 names on that list. But he would change over time. He would change based on the market, based on like what you said in the 0709. That really scarred him and scarred all of us who lived through it, and realize how bad that time frame was. Much worse than 2000 to 2002, because anyone who was clued in knew that we were really close to the brink of everything collapsing in the financial markets forever and us changing. And so when you were aware of that, it did change your risk tolerance, and he did spread out more. And after that, I did start spreading myself out as well. And I
Yeah.
feel comfortable with that. So you have to do what's comfortable with you. We'll get to the charts in just 1 second. I just want to say, if you're taking SwingTrader, which I hope you are, and you see all these alerts come through, don't feel that you have to. I'm going to say this every week. Don't feel like you have to ride along with every trade. Use it as an education resource, as well as just, hey, why are these people doing this? And maybe you'll find something in that same space. If we're putting home builders on, maybe look around. You might find a home builder you like more that is just too thin for us, because we try to keep things liquid. So we're missing a lot of thin names because of our liquidity requirements that are self-imposed.
Mhm. Yeah. And here's just a quick look at the S&P 500. You can see here was the 2000 to 2002. Of course, it was much steeper for the NASDAQ composite, which was down like, what was it, 79%. And then, here it was down like 57% in 2008. Very, very dramatic for the S&P 500 and very quick. So let's talk a little bit about some of the stocks that we're taking profits in. So Fang, Diamondback Energy, this was a breakout yesterday. We had actually gotten into it earlier, so we had a little bit of cushion. Had a breakout yesterday. Today, I mean, it didn't do anything wrong. It didn't break down, but you were taking profits here while we were adding to things like XLF. So why the why the change, and especially with something that looks a little bit more extended?
Good question. So let's go back to Fang. So I still like Fang. I think Fang's in a good position, but it's an individual stock. So you have the individual risk and um sorry, I'm fighting a cold. That pull up XLE and XOP for a second. Those are a couple of the energy related ETFs. And you can see that, well, when it pulls up, that the RS line here is just not they've been moving up, but not super strong. Let's go over to XOP. Just same thing there, and let's do OIH. Those are the three that I always look at when I'm looking at energy related ones. So the OIH that's kind of where the oomph is right now. So that's probably the space that we'd want to be looking in a little bit more and see if there's anything liquid in position. Let's go back to the FANG for a second. So taking profits here was a function of a few things. One, it was an individual stock. Two, it was in an area that wasn't really moving. Three, there was a few names in that area that were acting stronger. So I was thinking maybe we didn't have the right one there. And four, I wanted to allocate that money into an area that had already had a lot of the earnings behind them. So if we go over to the XLF, most of the big players there, the Goldman Sachs, the Morgan Stanley, the JP Morgan, the Bank of America, Wells Fargo, you name it, have already pretty much reported. So that risk is off the table. So as a risk reward that we're going with, so an individual stock versus an ETF, so you're broad based, and even the Berkshire, if you pull that one up, that one broke out and was looking healthy. So is this mean reversion trade that's going into things that haven't been working, and Berkshire hasn't been working for a long time, and it has that powerful move. That's part of XLF. So that's why I wanted to allocate some of our funds with SwingTrader over there. But yeah, that RS line, and that's something that Chris Gessel always brings up is, how it's been dead, for so long. But it looks like that is changing, at least in the short term.
Mm-hmm. Let's also discuss, with the time that we have left here, ARKK. Now, this has been a little bit controversial because a lot of people look at the chart here and how dramatically it went up and how dramatically it went down. So, what was kind of what is your thinking here with ARKK? Especially when you consider the Magnificent Seven and technology, maybe a little bit out of favor, but what's
Yeah.
the attraction here?
So a lot of the way I'm interpreting what's going on in the market is, even though I disagree and think that my personal opinion, which all personal opinions, mine and everyone else's, are worthless, but my personal opinion is the uh, the Fed is not going to do all the cuts that the market thinks it's going to do. But that's an opinion, and the market is telling you, based on all the evidence, that they think they're pricing in some cuts and a few cuts. And so what happens there is the stocks that are big and liquid and have tons of cash, like all the Mag 7 that are earning interest, sizable interest on those, they lose their competitive advantage when you shift into a period where interest rates are going the other way and starting to go down. So that means, the XBIs of the world, anything that's leveraged, so that they're using debt to expand that part of their life cycle. Those are the ones that are going to have an advantage, because now their cost of doing business is essentially uh, come down, and the advantage of the big caps that have all this money, that they don't need to raise money. If they can raise money if they wanted to, but they really have on balance huge cash piles earning interest. So that's the shift there. Now, a lot of these stocks, I've played through all the ARK stocks, and a lot of them were way out of position for anything that we would buy individually. So I didn't want to put those up, with the exception of Tesla, which I have a position in that's just not right for SwingTrader at this point. That, with the exception of that, pretty much all the other ones were out of position as far as the ARK type stocks, but they all look like they wanted, on balance, they look like they wanted to move higher. So this reduces your risk because you're spread out amongst all of those, and is a way for us to participate in that mean reversion trade. So let's go back to the monthly. This area has been left for dead for years now, and for good reason. And a lot of those stocks had individual stocks that Kathy Woods was in back then, and that she still has, individually have a lot of problems, but as a group together, they look like they want to move higher and do the mean reversion trade. So the first step was going into the IWM and the RSP. Then when that was sticking, that's when we started going into the ARKK. And I got so many questions like, why are we doing ARKK from anyone who could get a hold of me? That made me feel more comfortable, frankly. Is the more questions I was getting, the better I felt about it. Doesn't mean it's going to work. And I have a position in ARKK, a sizable one at this point. In that
And
RS
it
line,
was a little interesting
yeah.
that ARKK had that kind of ugly reversal on Thursday.
Well, that was the two of the biggest positions are Meta and Tesla, and they got hit really hard on that day. So that was, if you pull up Meta, you could see that that's been, and that was one that we were trading, and then that one got hit, and it's continued to be under pressure. That's a space that we want to, we would, excuse me, would like to go back in, but we're going to wait for it to prove itself and get back above 500 at minimum, if not the 514.01, which was the original pivot on that cup with handle, before we start playing there again. Because I like that space. We still have some mega caps on there. Like we still have our Apple position that's doing well. So all of them aren't coming under this type of pressure. But remember, we're heading into earnings season. So you're going to have these names gap up 10, 15, 20%, gap down 10, 15, 20%. So is another reason to go heavier with the ETFs as we go into the earnings season. Just so the gap downs, they'll hurt you if they're part of the ETF, but they won't hurt you as much, because with SwingTrader, as we get closer to the earnings report, we'll have to start peeling things off, because if we don't have enough of a cushion to withstand a gap down, we'll just have to take it off. And Microsoft is one that is probably on the bubble for that we still have a small position in. So anyways, that was a long way of saying that this is the thesis here, is that we're going into a mean reversion trade, meaning the stuff that hasn't been working for 2-3 years, that money is going to, my opinion is it is going to, my opinion based on the facts that we're seeing, is that the money's flowing there. That's where the puck is right now, and that's where we think is going to continue to go. Once we start seeing evidence that that's shifted, we'll shift, just like we made that shift into the IGV space in a big way, thinking that we were rotating there. We were early, and so we had to back out. So we'll be flexible because it's a fast product.
Mm-hmm. Well, I think that wraps it up for this week. If you haven't tried SwingTrader and you're kind of liking what you're listening to here, definitely go to investors.com and check out, a lot of the products that we have. If you like something a little bit more like position trading, we have Leaderboard. And then if you just like a lot of commentary during market hours, we also have IBD Live. So a lot to check out in terms of our offerings on the education side. And remember, at the end of the day, this is an education product. We really aren't trying to say, this is what you should be trading, this is how you should be trading it. We're kind of giving you a way of doing it. Everyone kind of has to find their own style, but hopefully the ideas that we're throwing out there, between all of them, you can find something that really works for you, and hopefully it gets you some portfolio gains. And that's our goal at the end of the day, to definitely more than pay for the subscription price. So thanks for joining us this week, and we will see you next week. Take care, everybody.